Welcome to Mysteel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. Today, we are looking at China's two sessions, the energy priorities emerging around the 15th five-year plan, and what they tell us about the country's transition path, carbon strategy, and industrial direction. Joining us today is Liao Na, Chief Consultant of Energy Policies.
Thank you. It is great to be here. I am looking forward to the conversation.
Before we turn to the two sessions themselves, I think it is worth starting with the broader market backdrop. In recent weeks, Middle East tensions have pushed up crude prices and freight costs, and that has clearly added pressure across industrial markets. At the same time, though, a number of China indicators seem to suggest that domestic recovery is still moving forward. So, how do you read that combination of global volatility and China's domestic stabilization?
Well, I think that is exactly the right place to start because the current environment is really being shaped by both forces at the same time. From a global market perspective, the most immediate impact from the Middle East tensions has been through costs and freight rates. Higher crude prices have fed quite quickly into domestic industrial prices. In March, the average Nanoir Industrial Products Index rose sharply month on month, and the increase was even more pronounced in the energy and chemicals segment. That tells us the cost shock has already passed down through the value chain, and we can see that price pressure being transmitted along the chain. In March, both the Manufacturing Purchasing Price Index for major raw materials and the ex-factory price index moved up to their highest levels since the second quarter of 2022. So in practical terms, upstream price pressure has become much more visible, pushing PPI back into positive territory earlier than expected. At the same time, the conflict has also increased risk premiums on regional shipping routes, especially around the Red Sea and the Gulf. Freight indices moved higher in March, so there is clearly an added logistics cost. But what is notable is that this has not translated into a visible drop in China export volumes. National port container throughput still recorded quite solid year-on-year growth. So the message here is that higher shipping costs have raised pressure, but they have not, at least for now, cut off the physical flow of exports.
So, the shock is real, but it has not derailed underlying activity.
Yes, exactly. That is the important point. The shock is showing up first through costs rather than through an outright interruption to production or exports. And on the domestic side, there are also clearer signs that the Chinese economy has been stabilizing. I would say there are three things worth noting here. First, China's domestic demand is showing signs of bottoming out. Fiscal support has come through relatively early, with local government special bond issuance for project construction running ahead of recent years. That has helped support infrastructure investment. At the same time, activity in civil engineering and construction has improved under the push from major projects linked to the 15th five-year plan. And importantly, the share of firms reporting insufficient market demand has fallen quite noticeably, dropping below 50% for the first time since mid 2022. That suggests downstream demand conditions are showing early signs of recovery. Second, demand from overseas markets has remained quite resilient and is still an important growth driver. In March, the Manufacturing New Export Orders Index rebounded quite sharply to its highest level since May 2024. And while exports to Europe and the US showed some marginal weakening, demand from emerging markets remained active. We can also see that in freight movements on South America related routes, which suggests that China's export structure is becoming more diversified. Third, production is also recovering steadily. Manufacturing PMI moved back above the 50 threshold in March after several months below it, which is a fairly clear signal that manufacturing activity has returned to expansion. And that improvement was not limited to one segment. It was visible across high-tech manufacturing, equipment manufacturing, consumer goods, and basic raw materials.
So, if we put that together, the picture is not simply one of geopolitical pressure, it is also one of improving domestic fundamentals.
Yes, that is right. I think the current picture is more balanced than a single risk narrative would suggest. Global volatility is raising costs, but domestic recovery and export resilience are still providing support. That said, there is also a clear risk here, and it is a profitability risk. The gap between raw material purchase prices and ex factory prices remains quite wide. In other words, cost increases have not been fully passed through downstream. And that means margin pressure is likely to be felt most directly by midstream and downstream manufacturing firms. So, really, the broader takeaway is that China's economy is recovering, but it is doing so in an environment where global cost pressure is rising at the same time. And that is exactly why the policy signals from the two sessions matter so much right now.
Let us start with the big picture. During this year's two sessions, what stood out most to you in energy policy? If you had to rank the top three signals, what would they be?
Well, I think the first and most important signal is that the goal of building an energy powerhouse has now been formally incorporated into the 15th five-year plan framework. And that matters because at its core, it points to a new energy system in which non fossil energy becomes the main supply pillar. So, this is not just a symbolic phrase. It tells us that during the 15th five-year plan period, China is likely to accelerate the restructuring of its energy mix. The second signal is that the transition targets are becoming much clearer. China is no longer talking only about renewable expansion in a broad sense. It is now setting structural targets, carbon intensity targets, and future industry targets at the same time. And the third signal is that policy is becoming much more enforceable. In other words, this is no longer only about direction setting, it is increasingly about implementation through carbon control, project access rules, and market based mechanisms.
So, this is really broader than just an energy transition story.
Yes, exactly. It is, in a way, a redesign of the system. The policy direction suggests that China is trying to connect energy security, carbon governance, industrial upgrading, and long term competitiveness into one framework rather than treating them as separate agendas.
And what are the main goals China wants to achieve during the 15th five-year plan period?
Well, I think there are really three core goals here. First is the structural goal. Non fossil energy is expected to account for 25% of total energy consumption, and almost all incremental electricity demand is expected to be met by clean energy. So that tells us quite clearly that non fossil energy is moving into a leading role. Second is the intensity goal. China aims to reduce carbon dioxide emissions per unit of GDP by 17%. And this is important because it signals a formal shift from the old system of dual control over energy consumption toward a new dual control framework focused on carbon emissions. Third is the industrial goal. China wants to cultivate future industries such as hydrogen energy and nuclear fusion as new growth engines.
That shift toward carbon control sounds quite significant. How does it actually affect industries and companies?
I would say it works through three main channels. First, project access, carbon emissions assessment can now act as a veto mechanism for new projects. So, if a project does not pass the carbon emissions assessment, it may not even get approval. Second, operating compliance. By no later than the end of 2027, sectors such as petrochemicals, chemicals, civil aviation, and paper are expected to enter the national carbon market. Once companies are included, they will have to manage emissions data, clear quotas, and absorb decarbonization cost directly into operating costs. Third, regulation and incentives. On the regulatory side, the government is improving carbon accounting and statistical systems and strengthening carbon assessment at local, sector, and enterprise levels. On the incentive side, it is promoting zero carbon factories and zero carbon industrial parks and supporting low carbon technology upgrades through dedicated funds.
So, in other words, the compliance requirement itself is changing.
Yes, that is right. In the past, many companies mainly focused on reducing energy consumption. But going forward, the focus is increasingly on carbon footprint itself. So the requirement is not only to save energy, but to directly manage and reduce emissions.
Now, some people still see a tension between economic growth and carbon reduction. How is China trying to balance those two goals?
Well, the policy logic is that they are not necessarily in conflict. Green transition is not being framed as growth sacrificed for climate goals. It is being framed as a way to create new growth through industrial upgrading, energy restructuring, and technological innovation. Take energy consumption as an example. Oil demand in transport may decline, but that does not mean economic value disappears. Instead, growth shifts toward electric vehicles, biodiesel, sustainable aviation fuel, and hydrogen fuel cells. At the same time, high energy consuming sectors are being pushed toward lower carbon development through efficiency upgrades, circular economy models, and carbon capture utilization. And new service sectors such as green manufacturing, low carbon materials, and carbon management services are also expanding. So, for China, carbon neutrality is increasingly presented not as an economic burden, but as a strategic opportunity for industrial restructuring and technological catch up. The real trade off is between short term adjustment pressure and longer term competitiveness.
And from the company perspective, what are the biggest challenges under this new framework?
Well, I would point to four main challenges. The first is compliance standards. The old model, where companies mainly tried to meet targets by lowering energy use, is no longer enough. They now need to respond to direct carbon footprint assessment. The second is management capability. Companies need to build systems for monitoring, reporting, and verification, and they also need internal teams that can manage carbon data in a professional way. The third is technology and transition cost. Decarbonization technologies such as CCUS, green hydrogen, and electrification upgrades are expensive. In some sectors, the cost increase can be quite significant once these technologies are adopted. And the fourth is direct carbon cost. Carbon prices are currently around 80 RMB per ton, but by 2030, they could rise to 150 to 200 RMB per ton or even higher. And after 2027, quota allocation is expected to shift gradually from fully free allocation toward paid allocation. So carbon cost is likely to become a much more visible burden for emitters.
Let us turn to the role of different energy sources. Has the positioning of coal, oil, gas, and renewables changed during this period?
Yes, quite clearly. The roles are becoming more differentiated. For traditional energy, including coal, oil, and gas, the role is no longer mainly about growth. It is about security. Coal remains the most solid foundation of China's energy security. China's domestic crude production is expected to remain around 4,000 barrels per day, and that is treated as a bottom line. Natural gas plays a dual role. It is both a transition fuel and a stabilizer for the power grid, with demand expected to peak around 2035 to 2040. For renewable energy, the role is growth. On the demand side, the focus is comprehensive electrification. On the supply side, the focus is on green hydrogen and methanol as substitutes for fossil based feedstocks. So the message is actually quite clear. China is not moving to phase out traditional energy all at once. The role they play in supporting energy security in the near term remains very clear. But when it comes to future growth, that is increasingly where green energy comes in.
And has the Middle East crisis reinforced that direction?
Yes, I think so. The Middle East crisis has strengthened the case for faster energy restructuring. In broad terms, it supports a faster move away from oil dependence on the consumption side, while also accelerating the development of modern coal chemicals.
That brings us to coal. China keeps talking about transition, but coal remains strategically important. How should we understand that?
Well, coal's role has clearly evolved. It is no longer framed simply as a tool for scale expansion or oil substitution. It is now seen more as a strategic anchor for national energy security, while the coal related industrial chain is expected to move toward higher end and lower carbon development under stricter environmental and emissions constraints. China still aims to achieve coal consumption peaking by 2030, but that does not mean coal use will fall in every sector. Coal use in power and chemicals is still expected to grow, while coal use in steel, building materials, and residential sectors is expected to decline gradually. And in chemicals, coal chemicals have moved from being a supplement to the petrochemical chain toward a strategic stabilizer under global uncertainty and geopolitical pressure.
So, are coal chemicals becoming a real threat to oil based production processes?
Yes, their strategic importance is rising, but we should not overstate their scale. In the short term, coal chemicals become more economical when oil prices are high. In the medium term, China has strong technology capability in this field. In the long term, they serve as a kind of security fallback under extreme geopolitical scenarios. But that does not mean unlimited growth. Their development is still constrained by the top level goal of peaking total coal consumption. So, the main role of coal to oil and coal to gas is not large scale market share replacement. It is more about technical reserve capacity and high end substitution in special circumstances.
And how is the coal industry expected to adapt to the low carbon trend?
The approval threshold is becoming much stricter, really. In the future, whether a coal chemical project can move forward will depend on whether it can balance carbon emissions and water resource constraints. The approval channel is becoming very narrow. For example, carbon assessment can veto a new project, and new high energy consuming projects are required to ensure that non fossil energy accounts for more than 20% of total energy use. And this is already affecting real project progress. In some key coal chemical regions, such as Jundong and Hami in Xinjiang, a number of projects have been delayed because they did not meet carbon assessment requirements. In practice, and green electricity and green hydrogen are increasingly becoming standard components of new projects.
Let us move to renewable integration. Green power consumption is obviously central to the new energy system, but where are the main bottlenecks?
Well, I would say the core bottlenecks are really system absorption capacity and resource constraints. First, there is the intermittency issue. Wind and solar are variable, and current grid flexibility is still not sufficient. That means curtailment remains a constraint on continued large scale expansion. Second, there are upstream mineral constraints. Minerals such as lithium, cobalt, and nickel are essential for storage deployment. And in the next planning period, supply shortages and price volatility could become a serious bottleneck.
And how does policy respond to that?
There are several directions. One is long duration storage, especially green hydrogen, ammonia, and methanol for cross seasonal balancing. Another is local consumption through direct green power links and zero carbon industrial parks. A third is improving market mechanisms, including green power trading, green certificates, and renewable quota systems. And the fourth is resource security, meaning stronger domestic mineral development and battery recycling.
Can electricity market reform really improve renewable energy consumption?
Yes, but well, not in a simple, direct way. It does not create absorption capacity automatically. What it does is bring the generation side and the demand side closer together through price signals so that the system gradually adapts to renewable variability. In practical terms, renewable generators are pushed further into the market while users are encouraged to adjust electricity consumption through time of use pricing. The idea is that those who help balance the system can earn more, and those who add pressure will pay more. That creates room for storage, virtual power plants, and flexible loads to play a bigger role.
And what are the limits?
I think there are two major constraints here. One is the physical constraint of cross regional transmission. The mismatch between Western renewable resources and Eastern demand cannot be solved by market oriented incentives alone. It still requires grid investment and coordination. The other is that the green premium is still not fully reflected in the market, so users do not yet have a strong enough economic incentive to purchase green power voluntarily.
Before we close, what is the one key takeaway listeners should keep in mind?
I think the key takeaway is that China's energy policy is entering a much more integrated phase. The 15th five-year plan is not only about increasing the share of non fossil energy, it is also about rebalancing the relationship between energy security, carbon control, industrial upgrading, and long term competitiveness. So, whether we are talking about coal, oil, gas, renewables, electricity markets, or downstream industries, these are no longer separate stories. They are increasingly part of one broader policy framework.
So, the broader message is that China is not treating energy transition and economic development as opposing goals. It is trying to restructure growth through transition and strengthen security through restructuring.
Yes, exactly. I think that is the main point.
And for those who would like to follow these shifts in a more structured and forward looking way, GL Consulting's China policy perspective offers regular updates on policy direction energy transition priorities, and the evolving competitiveness landscape across China's energy and chemical sectors. Thank you for joining us today, and thank you to our listeners for tuning in. We look forward to having you with us again in the next episode.